Thanks a lot. Thanks a lot, sir.
Sir,
Thank you,
welcome,
sir.
sir.
Thank you, Ramu, sir, Chairman, and
Yes, sir.
thank you, CAP Arul Jyoti ji. So, can I start the session, sir?
Yes, sir. Yes, sir. I
Thank
request
you.
our speaker to start the session, sir.
Sure, sure. Nalla evening, everyone. Please make sure that when we are taking this session, it is a two-way communication. Because if there is a one-way communication, it may happen that you are with me in the session, but actually you will not understand anything. So I would request everyone to please have your chat box ready and let's discuss an important topic today, which is fraud risk in financial statement. Friends, when we talk about fraud, what do you understand? Or what is the first thing which comes in your mind whenever we think of fraud? Kindly have your fingers in your keyboard or mobile and have your chat box ready. So first and foremost, what is fraud? Anyone in the group? You all are having this lovely course on corporate allied laws, and for last few days you are attending various sessions. So I thought of why not start with an important question. Whenever we think about fraud risk, what is it? I request everyone to please participate in the session so that it's helpful for everyone. So what is fraud? Anyone? Ganesh ji, Ramanathan ji, Pritha ji, Gokila ji, Harsh Kumar ji, Jay Kumar ji, anyone? Senthil Kumar ji. What is fraud? Please write in the chat box. It won't be you are coming and attending with your video off and doing your day-to-day activities, your audit, your consultancy, and joining this session. It won't be fruitful for anyone. So requesting all of you to please participate. Friends, if you are doing any assurance work, please have one thing in mind. What is that, Vivek? Audit not documented is audit not done. Anyone who agrees with this? Anyone who agrees or disagrees with this? Kindly write yes or no in the chat box. If you agree with this, kindly write yes. Audit not documented is audit not done. I will not be able to proceed to the next slide if we are
Yes,
not
sir.
having a communication. Thank you, Ramuji. Chairman sir has taken the lead and started replying. So I request others also please join us. Let's have a fun-filled session of 1.5 hours and let's take this forward. So I'll try and show you a small clip from a Bollywood movie, and you will understand the importance of this one line which I have just said. So the crux of the video was
Yes,
that the
sir.
code of law is believes only on paper, believes only on document.
Even
Court
if
कागज का
contrary
भूखा
present
होता है.
also. That is not evidence, sir.
Yeah, it's over, sir. It was the small clip which I tried to show in the movie Jolly LLB. It
Yes, sir.
says the judge says that the court is only believes on paper.
Yeah.
So if you are doing an audit, if you are doing any work, the code only believes on paper the facts which you are showing or the document which you are showing. So similarly, when you are in audit, if you are doing audit and you are not having a proper checklist, proper documentation, and if it is taken in the court of law, you will not be able to prove that you have done your audit properly. So that's why we say that the code requires paper. The court believes only on the document which is there, in spite of the person being alive. As per the document, the person was dead. Therefore, the court is saying that he is dead. So the crux of the matter is audit not documented is audit not done. When we talk about audit, the early history of auditing, Vishnugupta Kautilya, also known as Chanakya, first introduced the concept of auditing in his book Arth Niti. Similarly, Birbal, a great auditor for Emperor Akbar, gave him facts and solution on several complex matters with desired evidence. So audit is nothing new. It is very old. It has been there in the system. So we understand the importance of audit and the history of audit. Now, whenever I sleep, I have this fear as an auditor that whether my name will be there in the next news publication which comes out. So what we understand that audit has become a very important work. Earlier, we used to see a person was called a tax audit consultant, or a person was income tax consultant, GST consultant, service tax consultant. But no one said that he's an audit specialist. No one there said he's an assurance expert. In today's world, if you don't specialize yourself in assurance, you won't be able to do audit. Why you say so, Vivek? Because as we understood in the introduction slides, audit not documented is audit not done. And when we are doing audit, we have to follow all the standards which are there in accounting, as well as standards which are there in audit. So please tell me how many standards are there in accounting standards? How many accounting standards are there which is applicable on companies? Kindly write on the chat box. How many accounting standards are there which is applicable as on today? Anyone? We all are doing audit day in, day out. So how many accounting standards are there as of today? As I said, the session will be a two-way process. It won't be that Vivek will come, speak and go. It is both of us learning together. The simple question, how many standards are there in accounting? Vignesh sir, Jay Kumar, anyone? Anyone who wants to answer this? How many standards are there in accounting? Okay, let me take this. There are 27 standards on accounting. These standards on accounting are important, but the prima facie responsibility of following accounting standard is of the management. What is the responsibility of the auditor? To say whether the books of accounts show a true and fair view as per the laid down principles and policies of the company which are in line with accounting standards. But the primary responsibility of the auditor is to do the audit as per standards on audit. The auditor in his report under SS 700 for corporates, non-corporates, they are saying that I have done this audit as per standards on audit. So the auditor has to prove that he has done audit as per standards on audit. To prove that he has done audit as per standards on audit, his documentation should be as per standards on audit. And in the court of law, if he is not able to prove the documentation, then we had seen in that small clip what will be the problem. कोर्ट तो कागज का भूखा होता है. So I started the session with this question: what is fraud? The possibility of the organization being subject to fraudulent activity and the risk of fraud which can be existent within the organization's operation. These two are very important points. So when I say common fraud risk factors, I mean to say A business can lose a significant amount of asset due to fraud. At an extreme level, the effect of fraud can even shut down a company. Consequently, a business owner should make ongoing efforts to create an environment in which fraud is less likely to arise. There are a number of factors that make it more likely that fraud will occur or is occurring in a business. So when I say a business owner should make ongoing efforts to create an environment in which fraud is less likely to arise, what do I mean to say over here? What do I mean to say? Anyone? What do I mean to say when I say a business owner should make an ongoing effort to create an environment in which fraud is less likely to arise? See, friends, you have to answer. You have to answer to be alive in this session. Buying on and implementing internal financial control in regard to financial activities for which we give a report under ICFR. Okay. Nature of the item value. If item that can be stolen are of high value in proportion to their size, such
Sir, I think the network requires some clarity, sir. Not clearly visible, sir.
let me
Yeah, yes,
see.
sir.
Am I audible?
Uh, no, sir. It's, low, sir. Very low, sir.
Am, okay, am I audible now?
Yeah, yes, sir. Yes, sir. Yes, sir. Yes, sir.
This is very small and value is high, where the value will be 30,000, but
Sir, still there is some disturbance, sir, in volume. I think there is some network issue, sir.
Extremely sorry, there was some network issue at my end.
Yes, sir. Yes, sir. You will wait, sir.
So as I was saying, the size and value, if the items that can be stolen are of high value in proportion to their size, it is less risky to remove. Similarly, ease of resale. If the item which is stolen can be easily resold, then it is more likely to be stolen. Cash. If there is a large amount of bills and coins on hand, or cash in bank account, there is very high risk of fraud. Separation of duties, we call it segregation of duties or authorization metrics. The risk of fraud declines dramatically if multiple employees are involved in different phases of a transaction. The maker and checker concept is present. Since fraud requires the collusion of at least two people, thus the poorly defined job description and approval process present a clear opportunity for fraud. Safeguard. What assets are physically protected? When assets are physically protected, they are much less likely to be stolen. So some of the control environments are this. Documentation. When there is no physical or electronic record of a transaction, employees can be reasonably assured of not being caught. Time off. When a business requires its employee to take the full amount of allocated time off, they skip them from continuing to hide ongoing cases. As you will see in various MNCs, they send people on forced leave. That is the time off. The control environment of forced leave says if a person goes off forced leave, if he is hiding something, that can be caught. Related party transaction. When there are numerous transactions with related party, it is more likely that purchase and sale will be made at amount that differ considerably from market price. So whether the when there are too many transactions with the related party, whether the transactions are happening at the arm's length price or not, that becomes very important. Complexity of the transaction. When the nature of company's business involves a complex transaction, and specifically one involving estimates, it is easier for employees to manipulate the result. Dominance. When a single individual is in a position to dominate the decision makings, therefore the promoter-driven companies are more prone to fraud. Turnover. When there is a high level of turnover among the management team and among employees, when the senior people are leaving very easily or joining, too many senior people are coming and leaving the organization, the chances of fraud is high. Auditing. When there is no internal audit function, it is unlikely that incorrect or inappropriate transaction will be spotted. Today, only in the newspaper, we all were reading about the fraud done by the CFO of the Trident Hotel. Trident Group, there was a fraud where he siphoned off the cash. In that, it was said that he is the person who was not getting the OTP, but for some bank account, he changed the mobile number and he started receiving the OTP for the online banking. The maker and checker was not there. The internal audit were not able to catch it, but now it has come in the limelight. So we discussed earlier nature of the control environment. Now pressures. There may be various pressure. Pressure of what? Level of dissatisfaction, expectation pressure, and guarantees. So if the workforce is unhappy with the company, there will be more chances of fraud. If when there's a pressure from outside investor to report certain financial results, or by management to meet certain performance targets, or to meet balance sheet goals to qualify for debt financing, there is a high risk of financial reporting fraud. So when we talk about financial frauds, the pressure, the expectations, the pressure of expectation lead to a big fraud, because we were discussing with some of the CFOs that, sir, you are in a dual role. Number one, to show a true and fair view of the financial statement. Number two, to show a good result. How to keep a balance between the both? The expectations from the stakeholders are very high. So how do you maintain the true and fair view of the financial statement? That is the pressure. Guarantees. When the owners or members of the management have guaranteed company debt, there will be strong pressure to report certain financial results in order to avoid breaking the guarantee. So we have discussed about the control environment and pressure. Now we move to what is the requirement in auditing standards. Vivek, when we say audit standards, what are the requirements? When we talk about audit methodology, it is the audit procedure. We go for compliance procedure, substantive procedure. In compliance procedure, we go for test of control. Substantive procedure, we go for test of detail and analytical procedure. In test of detail, it's about test of transaction and test of balances. We all know about the assertions. Assertions defined in SA 315. They are representation made by management embodied in financial statement used to assess potential misstatement. Compliance procedure and assertions tested in it. When we talk about compliance procedure, meaning of compliance procedure are tests designed to obtain reasonable assurance that those internal control on which audit reliance is to be placed are in effect. That is what Sir said just now about internal financial control. The compliance procedure, that is test of control, will take me from a walkthrough from the point of initiation to point of completion of any process, whether it's sale, purchase or anything. And this compliance procedure will help me to, for the assertion tested through compliance procedure, help me to ascertain the following things: existence, effectiveness, continuity. Existence of the control, effectiveness of the control, and whether the control works continuously or not. Vivek, why we are talking so much of compliance procedure? Whenever we say about the fraud risk, if we say that the compliance procedure or the test of control, the number of issues in the compliance procedure which comes out in the compliance procedure is very low. So what are the chances of fraud happening in that organization? What are the chances of the fraud risk in the financial statement? Please comment. If a company, we go and review do the compliance procedure and we find out that there are too many issues. There are too many issues in compliance procedure. So whether the chances or what will be the fraud risk, whether the fraud risk will be on higher level or lower level. If the issues in compliance procedure is high, whether fraud risk will be high or low. Please answer, my friends. One-way communication is very difficult in online environment nowadays. Chances of fraud will be low. If the issues in compliance procedure is high, chances of fraud will be low. Anyone else? No, sir. If in the compliance procedure, the issues are high, the chances of fraud will be high. As I said, when you are doing a test of control, if you will see that the existence of the control is not there, or the control exists, but it is not effective, or control is existing, it is effective, but not working continuously. Any of this assertion fails, the chance of fraud rises. The chances of fraud rises. Substantive procedure. Substantive procedure, as I said about vouching, physical verification. It is the test designed to obtain evidence. Test designed to obtain evidence as to the completeness, accuracy and validity of the data produced by the accounting system. So it talks about completeness, existence, accuracy, valuation, presentation. The transaction is complete in all aspects. The documents exist. The transaction actually happened, accurately calculated. Valuation of stock and cost or NRV is proper. and the presentation required to be done as per the standards on audit or as per context standard has been done. So examples of assertions. Existence. How do we see existence? Through stock count on 31st March. We check existence assertion of stock. Completeness. Through cutoff procedure, we check completeness assertion of sales. Through test of detail of sales vouching, we check accuracy assertion of sales. Through NRV testing of inventory, we check valuation assertion of sale stock. Per usual of related party disclosure as per AS 18, we check presentation assertion of related party disclosures. So any question till now what we have discussed? Whatever we have discussed, any question till now? If there is no question, we assume that no one has understood anything. So can I move forward? Please be prompt in your replies in the chat box. Humble request. I think I should move forward. Thank you. When we are talking about fraud, what is the responsibility of an auditor relating to fraud? And where does the discussion happen in regard to same? SA 240. SA 240. The auditor's responsibility relating to fraud in an audit of financial statement. Friends, whenever we talk of fraud, there are two words which come in our mind. One is fraud, one is error. So can you explain to me what is the difference between fraud and error? Anyone who can explain to me what is the difference between fraud and error?
Fraud is the intentional wrongdoing, sir.
Correct.
Yeah. Yes, sir.
So Ramu sir said a very good thing. Fraud and error, the major difference is intention. Major difference is intention. Saurabh ji also says the same thing. Fraud is intentional. So when we talk about SF 240, it talks about fraud triangle. To some extent, we have discussed that in the pressure controls which are missing. Fraud risk factors, auditor responsibility, auditor risk assessment procedure, auditor response to assess risk of material misstatement due to fraud, withdrawal from engagement and management representation. So as I was saying, fraud and error. Fraud is intentional act by one or more individuals among management, those charged with governance, employees or third parties, involving the use of deception to obtain an unjust or illegal advantage. Although fraud is a broad legal concept, the auditor is concerned with fraud that causes a material misstatement in the financial statement. If the misstatement is not material, if the misstatement is not material, the auditor is not required to go in that lane. So two types of misstatement can happen. Misstatement resulting from fraudulent financial reporting and misstatement resulting from misappropriation of assets. So tell me, my friends, is it the duty of the auditor to go and search for frauds when they are doing audit? Is it the liability of the auditor if the fraud is not detected and later detected? Auditor is required to do fraud reporting. So my question is whether it is the duty of the auditor to search for a fraud when he or she goes for an audit. No, it's not their duty or liability. Saurav Kumar Gargi says no. Anyone else? It's better if we get ourselves collected over here, if we go wrong over here, than in the practical world or in the actual world. Anyone else?
Yeah, members are requested to participate in the discussion.
See, what happens, my friends? It may be that you get the CP, you get the certificate of participation, everything, but no point of attending a session and going without discussion, because you will not get the benefit of the session. You may take the certificate, you may get the CP, but the benefit of the session, investing time in the session, you won't get the benefit. So, it is correct. Sauravji, you're perfect, bang on. It is not the duty of the auditor to search for the fraud. If in the course of the audit it comes across a fraud, if it comes across or detects a fraud while doing audit, then the fraud reporting happens as per section 143 subclause 12. And the auditor is more required to go for fraud that causes a material misstatement in the financial statements. So misstatement resulting from fraudulent financial reporting and misstatement resulting from misappropriation of asset. There can be two misstatements. So, characteristics of fraud we have discussed. Fraud is intentional. Misstatement in the financial statement can arise from either the fraud or error. The distinguishing factor between fraud and error is whether the underlying action that results in the misstatement of the financial statement is intentional or unintentional. Fraud is a broad legal concept. The auditor is concerned with fraud that causes a material misstatement in the financial statement. So fraudulent financial reporting and misappropriation of assets. Misappropriation of assets, misappropriation of goods, misappropriation of cash. We were talking about fraud triangle. Fraud, whether fraudulent financial reporting or misappropriation of assets involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. So there has to be an opportunity, there is an attitude, and there's a pressure or incentive for doing the fraud. So these three triangles makes the fraud triangle. What are those, Vivek? Incentive or pressure to commit fraudulent financial reporting may exist when management is under pressure from source outside to or inside the entity to achieve an unexpected or to achieve an expected earning target or financial outcome. A perceived opportunity to commit fraud may exist when an individual believes internal control can be overridden. For example, because the individual is in a position to trust or has knowledge of specific deficiency in internal control. Individuals may be able to rationalize the committing of fraudulent act. Some individuals possess an attitude, character, or set of ethical values that allow them knowingly and intentionally to commit a dishonest act. However, even otherwise honest individual can commit fraud in an environment that imposes sufficient pressure on them. There is a director of finance and there's a new accountant which has joined the organization in a small company. The director of finance says to the accountant that we are going to revalue our land, which is there in Nungambakkam, which we had purchased as rupees 10 lakh 20 years back. So this land which we had purchased 20 years back, at 10 lakh rupees, We want to revalue the land, and the building on the land was of 30 lakhs. We want to revalue the building also. So the total land and building of 50 lakh, we want to revalue at 5 CR, 5 crore. And the Director of Finance says that you see the building value is increasing day by day. So do not depreciate the building. Do not depreciate the building. If we depreciate the building, the depreciation takes away the profit and we are not able to show the profit to the people. So he requests not to show this depreciation. It can be a pressure from the top. So we discussed incentive or pressure. We discussed incentive or pressure to commit fraudulent financial reporting, perceive the opportunity, and rationalizing the commitment of the fraud. So fraudulent financial reporting involves intentional misstatement, including omission of amount or disclosures in financial statement to deceive financial statement users. Manipulation of accounts. Detection of manipulation of accounts with a view to presenting a false state of affairs is a task requiring great tact and intelligence, because generally management personnel in higher management cadre are associated with type of fraud, and this is perpetuated in methodical way. This type of fraud is generally committed to avoid incidents of income tax, for declaring a dividend, to withhold declaration of dividend, for receiving higher remuneration. So when we have a manipulation of accounts, and if this manipulation of accounts is done by the CFO, Director of Finance at the higher level, whether it is easy to detect such frauds. I mean to say, fraud at the higher level of white collar fraud is easy to detect or not? Or the fraud at the lower level is easy to detect? Which one? Fraud at the higher level of the white collar fraud, can we detect those? Or we can detect the small amount fraud, or fraud are done at the lower level. Both. It is both correct, but the fraud at the higher level will be not easily detected, because those will be with the knowledge of the promoter or the core management or those charged with governance. So all the documentation and everything in regard to that will be done properly. There are numerous ways of committing this type of fraud, like inflating or suppressing purchase and expense, inflating or suppressing sales and other items of income, inflating or deflating the value of closing inventory, very, very common, failing to adjust outstanding liability or prepaid expense, and charging items of capital expenditure to revenue or by capitalizing revenue expenses. Fraudulent financial reporting often involves management override of controls that otherwise may appear to be operating effectively. Fraud can be committed by management overriding control such technique using such technique as recording fictitious journal entries, inappropriately adjusting assumptions and changing judgment, omitting, advancing, delaying recognition, concealing, not disclosing facts, engaging in complex transaction, and altering records. Please read this. recording fictitious journal entries, inappropriately adjusting assumptions, changing judgments, omitting advancing, delaying recognition, concealing, not disclosing facts, engaging in complex transaction and altering records. These are the techniques by which management override controls. Management override controls. How? Recording fictitious journal entries, particularly close to the end of the accounting period, to manipulate operating result or achieve other objectives. Inappropriately adjusting assumptions and changing judgments used to estimate account balances. Omitting, advancing, or delaying recognition in the financial statement of event and transaction that have occurred during the reporting period. Concealing or not disclosing facts that could affect the amounts recorded in financial statement. Engaging in complex transactions that are structured or to misrepresent the financial position or financial performance of the entity. Altering records and terms related to significant and unusual transactions. So when we say about misappropriation of asset, it involves the theft of an entity's asset and is often perpetuated by employees in relatively small and immaterial amounts. However, it can also involve management, who are usually more able to disguise or conceal misappropriation in ways that are difficult to detect. As I said, if the fraud is done by the higher level management, it becomes very difficult to detect. Misappropriation of asset can be accomplished in a variety of ways. Embezzling receipt, stealing physical asset or intellectual property, causing an entity to pay for goods and services not received, using an entity's asset for personal use. So as I was saying, fraud and error. If it is a fraud, if it is a planned act, it is difficult to detect. If it is an error, an unintentional mistake, it will be easily detected. So the fact that it is a fraud, it will not be easy to detect those frauds. So it may be goods can be anything in the premises. It may be machinery. It may even be daily necessity of office, like stationery. The goods may be removed by subordinate employee or even by person quite higher up in the management. Auditor can detect this by undertaking a thorough and strenuous checking of records, followed by physical verification process. Also by resorting to intelligent ratio analysis, auditor may be able to form an idea whether such fraud exists or not. Therefore, it is clear from the above that the fraud deals with intentional misrepresentation, but error on the other hand refers to unintentional mistakes in financial information. Intentional errors are most difficult to detect because those are intentional. And if it's unintentional, then it can be detected because the management has not put its effort to hide those activities. Defalcation of cash have been found to perpetuate generally in the following ways: inflating cash payments, suppressing cash receipts, casting wrong totals in the cash book. By inflating cash payment, examples of inflation of payments, making payments against fictitious vouchers. Making payments against vouchers, the amount whereof has been inflated. Manipulating total of wage rolls either by including therein names of dummy workers or by inflating them in any other manner. Casting a larger total for petty cash expenditure. And adjusting the excess in the total of the detailed column so that gross total shows agreement. So how can defalcation of cash happen? Few techniques of how receipts are suppressed: teaming and lading. Amount received from a customer being misappropriated. Also, to prevent such deduction, the money received from another customer subsequently being credited to the account of the customer who had paid earlier. adjusting unauthorized or fictitious rebates, allowance, discounts, writing off its debts in respect of such balance against which cash has already been received, not accounting for cash sales, not accounting for miscellaneous receipt, writing down asset value in entirety. So this is the way of suppressing cash receipt by casting wrong total, by carrying forward the wrong balance from the earlier years or earlier day balance. So what is the auditor's responsibility? To obtain reasonable assurance that financial statements are free of material misstatement, subjected to inherent limitation of audit, or fraud deliberately concealed so difficult to detect. But auditor is always required to exercise professional skepticism. As I was saying, detection of fraud and error. The primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. It is important that management, with the oversight of TCWG, place a strong emphasis on fraud prevention, which may reduce opportunity for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of detection and punishment. This involves a commitment to creating a culture of honesty, ethical behavior, which can be reinforced by an act oversight by those charged with governance. So, friends, what is an auditor required to do? An auditor conducting an audit in accordance with SA is responsible for obtaining reasonable assurance that the financial statement taken as a whole are free from material misstatement, whether caused by fraud or error. The overall objective of independent audit and conduct of an audit in accordance with standards on audit, owing to inherent limitation of an audit, there is unavoidable risk that some material misstatement may happen. So, the risk of not detecting a material misstatement resulting from fraud is higher than error, which I was saying earlier, that if there is a fraud, the risk of not detecting it is higher. If it is an error, it's unintentional, then the risk of detecting or not detecting is lower. If it's an error, it can be easily detected if it's unintentional. If it is intentional, then it won't be easily detected. This is because the fraud may involve sophisticated and carefully organized scheme designed to conceal it, such as forgery, deliberate failure to record transaction, or intentional misrepresentation being made to the auditor. Such attempts at concealment may even more be difficult to detect when accompanied by collusion. When two or more employees are colluding together to do a fraud, it becomes more difficult to detect it. The auditor's ability to detect whether the auditor will be able to detect or not, it depends on the skillfulness of the perpetrator. Whether he is a regular very old, experienced person doing the fraud, the frequency, in fact, the frequency and the extent of manipulation, how big or small is the fraud which is done. The auditor's ability to detect a fraud depends on factors such as skillfulness of the perpetrator, the frequency and extent of manipulation, the degree of collusion involved, the relative size of the individual amount manipulated, and the seniority of those involved. If the owner of the company, the CFO, and all those are involved, it's very difficult to see the fraud, to detect the fraud. If it is done by the lower level employees, it will be detected. Furthermore, the risks of the auditor not detecting a material misstatement resulting from management fraud is greater than those of the employee fraud. Correct? When obtaining reasonable assurance, the auditor is responsible for maintaining an attitude of professional skepticism throughout the audit. The requirement of SA 240 are designed to assist the auditor in identifying and assessing the risk of material misstatement due to fraud and in designing procedure to detect such fraud. Till now, whatever we have discussed, have we understood 1% of those also? Out of 48 people, only 1% says that he has understood something, 1%. Others, others have not understood anything. Then you should keep answering. If you don't answer, it is not an interactive session then. So fraud risk factor, event or condition that indicate an incentive or pressure to commit fraud or provide an opportunity to commit fraud. Audit complies with professional standards and legal requirement. Audit report issued is appropriate. So these are the fraud risk factor relating to misstatement resulting from fraudulent financial reporting. As I said, high turnover, significant portion of management compensation is represented by bonus. Frequent disputes between the current and predecessor auditor. Unreasonable demand on the auditor, including unreasonable time constraint. Auditor is asked to do an audit in 1 day. Auditor is asked to do audit in 1 day, whether it will be a good thing or bad thing. There is a history of security law violation of claims against the entity or its management. Significant pressure to obtain an additional capital necessary to stay competitive. So fraud risk factor relating to misstatement resulting from misappropriation of assets. Large amount of cash on hand or processed. Inventory characteristics such as small size item with high value. Lack of appropriate segregation of duties or independent check. Poor physical safeguard over cash, investment, inventory or fixed asset. Lack of mandatory vacation for employees. We have discussed all these points just for a revision. So I was asking a question. What are the fraud risk factors relating to misstatement resulting from fraudulent financial reporting? So fraud risk factor which is relating to misstatement resulting from fraudulent financial reporting are this, and fraud risk factor relating to misstatement resulting from misappropriation of assets are this. Now, circumstances relating to possibility of fraud. Discrepancy in accounting records, conflicting or missing evidence, problematic or unusual relationship between the auditor and management, and others. So discrepancy in accounting records, including transactions that are not recorded in complete or timely manner. All the transactions are not recorded on time. Unsupportive or unauthorized balance or transactions. Last minute adjustment that significantly affects financial results. Evidence of employee access to systems and records inconsistent with that necessary to perform their authorized duty. Tips of complaints to the auditor about alleged fraud. Conflicting or missing evidence. Missing documents, the management is not ready to give you Xerox. They are giving you Xerox many times, they are not giving you the original document. A significant unexplained items on reconciliation. Unusual discrepancy between the entity records and confirmation report replies. All these are conflicting or missing evidence. Problematic or unusual relationship between the auditor and management. Denial of access to records. Limitation to the scope of the audit. Undue time pressure. Do the audit in 1 day. I don't know how you will do. Unwillingness to facilitate auditor access to key electronic files. Denial of access to key IT operation. And unwillingness to add or revise disclosure in the financial statement to make them more complete and understandable. And what are the other circumstances relating to possibility of fraud? Unwillingness by the management to permit the auditor to meet privately with those charged with governance. accounting policy that appear to be at variance with industry norms. Frequently changing the accounting policy or estimates from straight line method to WDV, from a WDV to a straight line method. Tolerance of violators of the entity's code of conduct. Now we have discussed to some extent what are the fraud risk factors in the financial statement, the fraud risk factor relating to material misstatement and misappropriation of assets. Now we would be discussing the fraud reporting requirement. 143.12 reporting to central government. When the auditor has the reason to believe that an offense of fraud is being or has been committed, the auditor shall report the matter with central government within such time and frame as stipulated. When the fraud is of rupees 1 crore or above, then the auditor is required to report to central government. The manner of reporting is okay, it's theoretical, we can read, I'll give you the slides. If the amount is less than 1 crore, then the auditor is required to report to the audit committee. If the amount is less than 1 crore, the auditor is required to report to the audit committee. So, in this regard, Sub-Rule 4 of Rule 13 of the Companies Act states that the auditor is also required to disclose in the board's report the following details of each of the fraud reporting to the audit committee or the board which during the year. Nature of the fraud with description, appropriate approximate amount involved, parties involved if remedial action not taken, and remedial actions taken. What are the remedial actions which has been taken? Please go through this slide. Fraud involving amount of less than 1 crore, report to board or audit committee, or disclose to board report and disclose to board report. Within 2 days of the knowledge, report the following matter: nature of the fraud and description, appropriate approximate amount involved and parties involved. If fraud is more than 1 crore, report to central government. Within 2 days, report to the board and committee. Take a reply within 45 days. If the reply doesn't come, then stipulate that reply has not come and report to the central government. And if replies are received within 15 days of receiving the reply, please report to central government. What is the auditor's risk assessment procedure? Professional skepticism. Do not take client integrity and honesty for granted, and audit evidence obtained suggests possibility of material misstatement due to fraud. Do not take the client integrity and honesty for granted. Discuss discuss among the engagement team. Discuss susceptibility of financial statement to material misstatement due to fraud. How and where? Experienced team members share insights. Evaluation fraud risk factor, inquiries of management, the process for identifying and reporting to fraud risk. Inquiries of employees, in-house legal counsels, chief ethics officer. Any knowledge about actual suspended or alleged fraud affecting the entity. So auditor response to risk of material misstatement is fine. Auditor unable to continue the management. When should an auditor consider withdrawing from engagement? Very, very important point. Exceptional circumstances. Entity does not take the appropriate action regarding fraud. The auditor considers necessary in these circumstances, even when the fraud is not material to the financial statement. Auditor consideration of the risk of material misstatement due to fraud and result of audit test indicates a significant risk of material and persuasive fraud. Auditor has significant concern about the competence and integrity of management or those charged with governance. Determine professional and legal responsibility and reporting. Appointing authority, regulator. So this was all about the fraud. Now, I would like to understand or discuss some of the practical aspects. Some of the practical aspects when we do audit. Anyone till now in their life have ever come across a financial fraud? You can switch on your audio, you can switch on your videos. Anyone in your life has come across frauds? A financial fraud, obviously. Anyone? So I suppose South India is having clean financials, no fraud, nothing. I'll share some practical examples with you. Number one, there was a client where we did a forensic accounting where the client was in the business of having chain of restaurants selling biryanis. Similarly, as you get the biryani in Anjappar, the Chetinath biryanis, Thalapakatum biryanis, they sell this Kolkata biryani. So what happened during COVID, the cash sales were very less. But post-COVID, the cash sales were very high. So what the management, the accounts department, or the cashier was doing at the store level, he was taking the cash for the cash sales and showing it as a Zomato sales or Swiggy sales. By doing so, he was siphoning the cash and showing the sales which was standing in reconciliation since long. So when we checked all the operation, the software at the POS, the software at the accounts level, and tried to do a reconciliation with the reconciliation of all these third parties like Swiggy, Zomato, Paytm. And we found this big fraud where the cashier was taking the cash home and he or she was not depositing the, not showing the cash sale and was showing all this as a Swiggy sales. So this can be a way of fraud. Secondly, in one of the instances I saw that in a manufacturing company, although the audit has not happened, when the auditor goes, prior to auditor going, the management has detected a fraud. What was the fraud? The accountant or the cashier was having the online banking ID and password. So he was transferring some fund to his known people. And in the books of accounts, he was passing the entry, FD account debit to bank. So in balance sheet or in the bank statement, the entries are expense accounts debit to bank. And in books, it was showing as the FD account to bank. And cash was getting siphoned off. The employee was 15-year-old employee working with the company. So no one had any ray of hope or doubt on the employee. But when this was unearthed, a proper forensic audit was done and the amount came out to be very big. The amount came out to be very big. In one of the retail chain where we were doing internal audit 10 years back, as per the management policy, the internal auditor, the in-house internal auditor was required to certify all the goods which came back to the retail store and was destroyed or broken. So the internal auditor was certifying that this broken items or expired item was crushed, broken in front of us, and this was sold as scrap. When we went to do audit, we found that the certificates were not there. And every quarter the scrap sale was there. So when we inquired, we came to know and it was unearthed that good items, the items which were actually good to be sold, it was shown as scrap and the money was taken by the scrap seller at the full amount and pocketed by the cashier, the store manager. So these are the ways, or these are the areas in which frauds do take. And during COVID, when there was a financial crunch, and with the COVID acting as a catalyst for digitalization, it has become very important for all of us to have a focus. And whenever doing audit, have the third eye open to see, to connect, and to understand if a fraud had taken place or not. This was the deliberation which I had for all of you. I had kept last 10 minutes for a question answer or discussion with the very enlightening team who is attending the session. So anyone having any question, anything to understand, I'm ready to hear. So that was all from my end. Over to the audience. You can unmute yourself and ask the question if required.